Today, we will talk about equity financing. Equity financing is the process of raising capital through the sale of shares. Companies raise money because they might have a short-term need to pay bills or need funds for a long-term project that promotes growth. By selling shares, a business effectively sells ownership of its company in return for cash. Equity financing comes from a variety of sources, such as friends and family, professional investors, or an initial public offering. Equity financing involves the sale of common stock and other equity or quasi-equity instruments such as preferred stock, convertible preferred stock, and equity units that include common shares and warrants. This action can affect existing shareholders and impact the ability to reach new shareholders. A startup that grows into a successful company will have several rounds of equity financing as it evolves and typically attracts different types of investors at various stages of its evolution. Individual investors are often friends, family members, and colleagues of business owners. They usually have less money to invest and may have no relevant industry experience, business skills, or guidance to contribute to a business. Angel investors are typically wealthy individuals or groups interested in funding businesses they believe will provide attractive returns. They can invest substantial amounts and provide needed insight, connections, and advice due to their industry experience. Typically, angels invest in the early stage of a business's development. Venture capitalists are individuals or firms capable of making substantial investments in businesses that they view as having very high and rapid growth potential, competitive advantages, and solid prospects for success. They usually demand a noteworthy share of ownership in a business for their financial investment, resources, and connections. Here are 5 key takeaways. 1. Equity financing is used when companies need cash. 2. It is typical for businesses to use equity financing several times as they become mature companies. 3. There are 2 methods of equity financing: private placement of stock with investors and public stock offerings. 4. Equity financing differs from debt financing. The first involves selling a portion of equity in a company, while the latter involves borrowing money. 5. National and local governments closely monitor equity financing to ensure it's done according to regulations. Hope this would help. Thanks for watching.